Hey guys, it's Mandy Gatlin with Be Passionate and Prosper, and I wanted to go over how I am able to, or how I was able to retire early. And I did that with three different things, but in this video, I'm going to focus in on how I did that through investing. So the other two ways that I did that was I owned my own business first. That was actually how my whole journey started. It was just by basically starting a business of my own and building it up with time. And then the second way that I was able to retire early was through real estate, which is something that I still do. And the businesses that I own now are more my passion. I call them passion projects. They're not so much, in my mind, they're not so much about like making an income. And I do make some income from them, but I'm not I'm not trying so hard like I was when I was younger and owning a business. But I do suggest that as a tool or a way for you to be able to make money quicker. And I will go into that in a whole other video for you. So today I wanted to just focus on the third way that I was able to retire early, and that is through investing, and more specifically, investing in index funds or mutual funds. So I wanted to go over that today, and I wanted to show you guys some of the ways that you can get started very easily, and my recommendations, and I'm going to give you some things that I did and then some things that I did wrong to help you avoid making mistakes in the beginning, okay? So to get started about what is an index investing, what is an index fund, what is a mutual fund, basically it is a basket of stocks, okay? And that is a mutual fund. So when you invest, when you're going to go invest in, say, the stock market, with a mutual fund, you're not just investing in one stock, okay, like say Coca-Cola or something like that. You're investing in a mutual fund, you're investing in many stocks and bonds sometimes. Sometimes it's a whole combination of different stocks and different bonds and just different funds, okay, that come together, and they are actively managed usually by a manager at a company, okay? So that person and their team is in charge of making sure that they are picking the right funds to be the right stocks to be in that fund, okay? Now an index fund is a type of mutual fund, but it is following one of the top indexes. So I'm going to show you how I do this online. I do it all by myself. I have through the years made the mistake of hiring people to do that. And if you're just starting out and you're really scared, then what I would suggest is educating yourself first. You can go sit down with a professional. I am not a professional. I should give you that disclaimer in this video. I am just a person who was able to make a whole lot of money through the years. So I think that counts as expertise, but I am not a professional. So if you feel like you need that, then I definitely say go seek that out, find the right person, interview a couple of people. Don't just go with the first person that you meet, and make sure that it feels like a fit to you, okay? And that's true in life for anything. That's actually good advice for anything, a lawyer, a doctor, anything. So what I would say to you is you can do this on your own. It's actually not that hard. It takes a little bit of education. If you follow along with me here on my blog and on my videos, you will learn enough to be able to do this on your own. And you'll actually feel better about that, I think, because a lot of the stuff that's out there, the people who do help you that are advisors, they tend to be more like salespeople. So they are really trying to sell you something, get you to, invest with them, turn all your money over to them. So for example, this advisor, if they get, $100,000 from you to manage, they take a cut of that, a management fee to be able to, watch over your money for you. And that's thousands of dollars. It's not just like $100, it's thousands. So I say you can do this on your own. I think it's a fairly easy thing. I mean, I'm a college educated person, but I'm not that like super savvy, techie, and investment savvy. I mean, I just know the basics, and I've read a lot. I did go to seminars. I spent the time, to educate myself. So if you're here watching the video, then I'm proud of you, because it means you're taking steps towards educating yourself. And that's really the most important thing with any of this. It will make you feel better at night if you have education. Usually, if you have anxiety around money, usually it's because you don't have the information. That's all it is. So if you start to feel anxiety about something, then reach out to a professional or go online and try to find someone who has the information and can give it to you. And once you have it, usually that will make you feel better. Okay, so with index investing, you basically want to find what I call self-service brokerage company. So I like Vanguard, they're my favorite. I also use Fidelity. People in my family that I trust that do well with investing use Charles Schwab. I have used companies that are more like advisor type companies. I'm not going to name them here because I don't want to down or diss anybody. But if they have like a brick and mortar and you have to go in and sit with a guy and the guy is telling you, oh, you should hand over all your money to me and I'll manage it for you, and here's some other ideas we can do with your money, that's probably a no. Okay, I'm just going to say it. So there are companies like Fidelity actually do have brick and mortars now, and you can go sit down with them. But I am encouraging you to try to do this more online and not have to really like depend on somebody, because if you're doing that, then there's always that chance that they are going to sell you on something. So I'm giving you like tips to try to help you, encourage you, empower you to do this on your own. So I would encourage you to look at Vanguard.com online, or use Fidelity.com, or use CharlesSchwab.com, and play around in the website a little bit and get a feel for what it's like. Go on each of them, and you're probably going to see that they all have kind of the same layout, the same, it's all going to be about giving you fund information. Okay, there's going to be like a tab for finding your funds, looking at your account. Okay, there's going to be a tab for that. There's going to be a tab for like research. There's going to be a tab for getting your forms, your tax forms, and all that kind of stuff. So all of these companies are going to have the same kind of layout inside of them. And I would suggest spending some time looking at each of them and kind of familiarizing yourself with what it's like to be on an online platform. Now, this, what I'm giving you today, this is not about day trading, okay? This is about long-term, getting your money, saving your money, getting your money into a fund, okay? Letting it sit in there, watching it. So you're going to be kind of tuning in, going in, looking at the chart. I'm going to show you how to do that on this video. You're going to look at the chart. You're going to say, oh, it's going up. Oh, it's going down. Okay. You're just going to watch it like go up and down. This is what the market does. It goes up and down. But generally the market goes up. Okay. And I'm going to show you that on this video too. So you're going to see that on the screen. So I'm going to show you how it goes up, okay, over time. You want your fund to basically be going up over a period of time. You want to make sure that the fund you're in has an upward trend, okay? I'm doing that on our video, but it's probably like this to you. So you want it to be in an upward trend, okay? I've been in funds that have been like this, you know, just kind of going like basically sideways. And I've been in funds that have gone down, right, over time. You don't know that until time goes by, which is unfortunate. And you cannot time the market and you cannot know the future. So all you can look at is your current performance. What has this fund done? What is the current performance of this fund? So you want to be checking in. Like I like to check in at least once a week. When I was first investing, I was looking at my funds daily because I encourage you to get a feel for what the market does. It's good for you to know and check in. Even in the morning sometimes, I'll just look at my app. It's Yahoo Finance. That's what I use. It's free, okay? All you have to have is a Yahoo email account, and you go in and you can look at the S&P 500, you can look at the Dow, you can look at the NASDAQ, you can get a feel for what these indexes, those are indexes, you can get a feel for what they're doing. So I encourage you to, when you're first starting out, to go in and look at that each day. It's like a 2-minute check-in. You go in there, you see, oh, okay, the market is up today. Oh, okay, the market's down today, right? I want you to get used to that and get to the point where you're not reacting emotionally to it, because when a lot of people start to get into investing, all their emotions come up and they get really worried and they get panicky about their money and they start to doubt the market, and then they start to think that they can control, the timing of things and all that, and you cannot, okay? I'm just telling you, you cannot. It's not possible. I have read up on this. Professionals that claim they can, show me your account and I'll show you days where you were down, okay? I'm putting it out there. Nobody out there has ever been able to only have gains. That is not possible in the market, okay, in playing in the market. So this is about entrusting your money to our, indexes that are generally going up. So I'm going to show you that now. So I'm going to share my screen. So give me just a second while I do that, okay? So let me, okay. So I'm going to show you, I'm going to go into Yahoo Finance. Here we are. Make me a little bit bigger so you can see me. Okay, so I'm already in Yahoo Finance. To get here, all you have to do is go to yahoo.com, and then there's a tab at the top of yahoo.com. There's all these tabs. Just click on Finance, and that'll take you to the Yahoo Finance page. When you get in, it may want you to be logged in, so you may need to set up a Yahoo account. You may need to set up like a Yahoo email, or just use if you already have a Yahoo email, just put in your username and password and you'll be able to get in to all of this, okay? So I want to show you like the this is the S&P 500 actually. This is a chart, okay? I don't know where you are in your investment journey, if you've ever even seen a chart before, but welcome to charts if you've never seen one. Most likely you have. I mean, if you're curious about investing, you've probably seen charts before, but I want to show you just the basics. So when I do a check-in on Yahoo Finance, I usually will click on these 3 indexes to see where the market is, what it's doing, how, what it's shaping up to. Are people freaking out and selling, or are people really excited and buying? I just want to know. And so this is the way to get started. And I want to kind of wet your feet with this because this is what I use. And it's what you need to be able to understand investing. This is just the basics. Now, you can do charting and you can do fundamentals when you do investing. I am a chartist. I look at charts strictly and that's it. I will kind of look at the fundamentals of a company, but I do not like to spend hours of my day researching about a company. If I'm doing stocks, if I'm doing funds like we're going to do, index funds and mutual funds, then you do want to spend a little bit of time on the prospectus and on the chart of that particular fund, okay, to understand. But to make things super simple for you, and this is how I did it, I would just suggest investing in an index fund that follows the S&P 500. Okay, the S&P 500 is basically a basket of American large companies, the top 500 companies. And if you have a fund, like an index fund, it basically, and it matches the S&P 500, it's basically matching up the S&P 500. Okay, that fund is matching the S&P 500. So there isn't, the other benefit to this is that there isn't a active manager usually. It's set into a computer, and the computer is following the S&P 500. So the benefit to that is that then you don't have to pay that manager and his team to be actively managing something. So what does that mean for you? That means lower cost for you. So generally there is a lower cost ratio when you look and you research. That's in the blog post. When you research a fund, you want to look for a low cost ratio for the fund. It needs to be like 0.10 or 0.09 or less than 0.25 is what I'm going to tell you. If you're around there or lower, then you're doing really well for your cost on your fund, okay? So you want to start with each day going in, looking at the market and seeing what it's doing. Now, this is a day, we're looking at the September, October, November, December. This is a couple months worth of the S&P 500. Okay, so it's showing you what's been happening for the last couple of months in the S&P 500. The little bars down at the bottom are volume. That's how many people are either buying or selling, okay? The chart itself, and as you hover over, this is each day. This is the actual amount where the market was, okay? So it's super simple. You can look at the 1 year and the 5 year on these charts. And that's what I want you to start getting used to looking at. I don't want you looking at the day chart because that will drive you insane. I used to do that. I used to day trade. it drove me bonkers. Okay. It's like watching paint dry, basically. I mean, the day chart is just showing you what's happening in an entire day. And if you want to day trade, you think you can do it, go for it. I'm telling you, it's really hard. And the people that I know that do it they're bald. They've lost all their hair and they have hernias. It stresses you out. You don't need to do that. I am talking about long-term saving your money, investing it every day, and putting away every month, putting away a set amount of money, and just letting it sit and letting it go long term. Okay, that's what we're talking about. So, and to do that, you need to be able to save money automatically. So the other part of this is getting into setting yourself up, like initially a savings account at a bank. Okay, if you already have a checking account, that's okay, but you want to set up a savings account. And every time you make income, I want you to just automatically off of that income save a certain percentage. Pick a percentage now, even if it's 1%. Okay, even if it's $10 every paycheck, I don't care what it is. It just needs to be an automatic amount, and that amount comes right off the top before you pay any of your bills. It goes into your savings account automatically. You can set up an automatic deposit or automatic withdrawal to happen into your account. Okay. If you want to go a step further, you can set up a money market account at Vanguard or Fidelity. So you just go into Vanguard, set up a new account, a brokerage account, and you can have that money from your checking account automatically be deposited into your brokerage account. Okay, now once again, you're not touching that money. It's going into your brokerage account, into your money market fund, and we're letting it sit there so that you can build it up until you have the minimum amount that you need to get your first mutual fund or index fund. Usually, I think it's around $2,000, $2,500 to buy into these funds. Some of them now require like $10,000 before you can get in. Okay, so it depends on the fund. That's all in each fund's information, right? So I'm going to give you some funds to check out. I'm going to give you an idea of how to put them in a watch list here on your Yahoo Finance watch list, so that you can make a decision about which one feels good to you, and then you can go and have that as your goal this year to make your first purchase, okay, to buy in. And the goal here, again, is to just send that money directly over, have it save automatically. This is the only way that I was able to accrue a real, true, hefty savings for myself was by doing it automatically, having it save automatically into my account, and doing it consistently. So those two things, you know, every single paycheck that you get for this year, have it go automatically in and be consistent. Allow it to go in every single paycheck, okay? Some of you might be going, yeah, but I have like debts, credit card debt, this and that. I understand. When I first started out, I was in the same place, and you are not going to get anywhere until you make some changes. Like in your mindset, it's all about this is going to be a long-term plan anyway, and you're going to start paying back your credit card debts. You're going to start paying back, you know, all of these debts that you have with time. And you'll be able to do that if you follow along with this and you say, okay, I'm going to change how I am with money. I'm going to stop spending it like when I don't have the money to spend, really. So there's a lot of mindset stuff, and I cover a lot of that in my blog. But it's basically about changing your mindset and not spending on things that really are just things that you know are going to give you temporary happiness. Stop spending on that stuff and start creating a plan for yourself to create wealth for yourself, to be able to build up an account so that you can retire early. If you do this, I'm telling you, I know you can do this probably within 7 years. I didn't have any of this information. It took me much longer, and it took me a good 15 years to get to this point. So if you do this and you follow along and you're able to change your mindset on stuff, within this year alone, I can guarantee that you will not only be able to pay down your debts, but you will be able to have a small amount of money and in savings and be able to actually invest in your first fund if you haven't already. So if you're here to get more information on index funds, then I'm going to go over that with you. Okay. But if you're just starting out, then I'm kind of helping you in terms of like things to do, you know, and look at this as a long-term goal for the year. Okay. And it's possible. It's totally possible. So what we're looking at here on this chart, this is a 1-year chart. And as you can see, this is mostly 2018 that we're looking at. We just hit into 2019, you know, right here. But for the most part, 2018, we were kind of on an upward trend. We had major gains here, you know, in 2018. And then as the year started wrapping up, things started to get a little bit bouncy, and now things have come down. And this is where people get into like panic mode. They're like, oh my God, I invested money and my money's back down to where it was. You know, a lot of people say that kind of stuff to me. And there's a couple of other things that happen in your fund. Okay, you will earn what's called dividends. That's basically like a reward. If you stay in the fund for a period of time, then they pay out what's called a dividend to you. And that money actually helps you recuperate, you know, any losses that you are making, you know, or that you're incurring in your fund while the market's going down. But again, we're doing this long term. And generally, I'm clicking on the 5-year chart. Generally, the market is in an upward trend. Okay, even though it has times of coming down and times of resting, it's generally in an upward trend. Okay, so this is the max chart. This is going back, look, into the 50s, you guys. So as you can see, the market has had times where it's pulled back, where it has rested, where it's come down, okay? And you can look at these times. Now, I mean, look at this, like here in the 60s, how much of a bear market they were in here, right? And like that was just 1 year. Okay, 1962. Scary year for people. But they came out of it. Now, if you reacted, you know, and was like, oh, here we're okay in 1961, we're fine, right? And then 1962 comes around, it looks like about, I don't know, April. Probably a lot of people have this memory in their mind if they're that old. April, May, June, the market started to tank, and a lot of people, and look at all the volume, look at that spike in volume right there, all those people freaked out right in there. And then the next couple days were really bad. So you know, this is what happens. People react. They see, oh my God, my savings. Oh my God, my savings. It's going down. I'm losing. And then they start pulling out all their money out of the market, and then they never want to be back in it again, and they don't trust the market anymore. But then look at what happened. You guys, this is just a year. And then within, let's see, 1963, January, they were already coming back. They were already, the market was already coming back and recuperating. Okay, so you see what I mean? It's, there's definitely times, years, where we're going to have these resting points or like these lulls, you know, and your job in this as your own active manager of your fund is to just ride through it and not get panicked because the market keeps going up. So I'm going to show you guys, here's the market continuing. Okay, look, and just look and see. I mean, it's showing you year by year how the market trended continually up. That's because our economy is amazing, you guys. It's continually flourishing, continually expanding. So I want to show you this just so you get an idea of what the market does. Now, those of you who are kind of new to this and been around, I don't know, 20 or 30 years, maybe you were around during this last big dip, the 2008-2009 dip. And again, look at all the volume. This is all the people who were freaking out, you know, when the market was going down. And if you sold out of everything and didn't ever get back in, then you missed this huge rise, you know, through the next many years here. But it's just gone up and up and up. So yeah, we're expecting another dip. It's coming down. That's okay. I'm not about timing the market, but I will tell you guys that if you can buy in when the market is going down, you know, people who trade say to buy on the dip. If you can buy while it's going down, if you can stomach that, you're going to get a much better deal. And I say to use dollar cost averaging to your advantage. Dollar cost averaging basically means that you are buying every month consistently, and sometimes you're buying on a peak, sometimes you're buying on a dip. And what happens with dollar cost averaging is you end up benefiting because you're buying on peaks and dips. So your money averages out, but you generally tend to make a benefit or a gain out of that. Okay, when you're able to invest every month. If you try to time it and put all your money in on one particular day, you may end up buying on a high day. And then if you wait a year to buy again in, you might buy on another high day. So then you're only buying on these peaks. Okay, so that's why we're suggesting that you purchase, you know, and keep consistently purchasing, because it helps you to purchase on peaks and valleys throughout the market. Okay, and also it takes out the whole concept of you having to time anything. That's stressful. We don't want stress in your life. We just want ease and grace, and ease is just applying yourself to a new habit. And this new habit is, I'm just going to invest every paycheck, and that's easy. Okay, so as you can see, you know, the market is currently, if you're watching this video right now in 2019, early 2019, the market's coming down, but that actually can be a benefit to you. So don't wait. That's the other thing that I cover in the post. you don't want to wait, because if you wait, then you could be missing out. And you never know what the market's going to do. If you research things properly and you educate yourself, you're going to see that when you invest, if you can allow your money to stay in the market, then you are going to benefit from the couple of days in the year when the market really pops up. So, and that's too hard to time. You will never know when those days are going to be. Okay, so like look at this day right here. The market popped up. Okay, so that's why you want to be in long term, because there are days when it's going to do that and you just can't time it. Okay, so I want you to look at the 1 year, the 5 year, the max chart, because I want you to continue to see that your money's fine. It's long term. It's going to be doing fine long term. And we're not about looking at 5 day or 1 month or 3 months. Okay, we're not about looking at those time frames on a chart. So I wanted to cover that in depth to help you guys start out with something. So use the Yahoo Finance. It's free. Use it to your advantage. Now you can look at the other indexes as well. So there's the Dow and there's the NASDAQ. Generally, the charts they look pretty similar when you are looking at them. Just make sure when you click on them that you do change the time range, because the time range that pops up is always a day. So you might pop it up and go, oh, everything's fine, you know. But you want to look at like the 1 year. Now, if it changes red, that means that's showing in a year we're down. Okay, if it goes to green, then it's showing in that time frame we were up from the start to the finish. So this is the 5 year. And you can see that this chart is also trending generally up. So the indexes tend to, that's what I wanted to cover. They tend to go up. You can benefit from that by investing in an index fund, because the index fund, what the index word means, it just follows one of these indexes, okay? And it has a very low cost to it. There also tends to be a low turnover rate in those funds, which means that people like you and me that are interested in them, we tend to just stay in them. We don't tend to move our money around too much, because we know it's following the index, it's probably going to do okay. So that's where you want to just kind of, you know, trust that this is a good fund to be in. It's totally fine, you know, and let your money just kind of sit in there. Now, if you have an advisor, advisors tend to do whatever you want them to do. I mean, if you tell them sell out right now, you know, they have to do that for you, but they will generally advise you like about the things I'm telling you, which is you want to be in this long term, you know, they're going to say the same things to you. So you're going to end up paying them thousands of dollars a year to tell you the same thing. Okay, so they're just managing you and your fears. That's all they're managing. So if you can get a hold of that, and you know, if you need to reach out to me in an email and say, hey, I need help, I'm freaking out right now, email me and I'll be happy to nudge you back and say, calm down, everything's going to be okay. You know, people do that with me. That's what I'm here for. So if you need that, you know, or if you want me to address a video on fears and, you know, how that can impact your decision making, then let me know. I'd be happy to, you know, help you guys out in that way. Trust me, I've been there. I've been through this before. You know, all the stuff you're going through, I've gone through it. The other thing that I want to cover is the watch lists, how to create little portfolios for yourself in Yahoo Finance, because I love this as a tool. and it's totally free, so you can use it. So you can set up a watch list. I like to use the My Portfolio. So you would just click on portfolios. Now these are portfolios that I have already set up, and I have funds in there, and the symbols are already in there for each of the funds. So I'm going to show you guys how to create one. You basically just come over here to the plus create portfolio and you name it. So let's call this S&P Index Fund Watch List, because we're just going to do index funds. I've already written down some funds for us to look at. Some of these do follow the S&P, some are other index funds. So I'm just going to put them all in, but you basically want to click on add symbol, and then you're going to type in the ticker of some of the funds. Now this one's popping up as the Vanguard 500 Index Fund. This fund is in Vanguard. It's available through Vanguard, and it is a index fund that follows the S&P 500. So as you can see, when you type in this fund, it's going to show you the price here. So here's the share price. This is the day, what it did. So it went down $5, you know, but that's actually, it sounds like a lot, but for a fund that's at $226, that's just a very small percentage. It shows you the year-to-date returns. There's a lot of information down here that you can look at, okay, that you can read through. This is more like fundamental kind of information. And again, I love charts. So because a chart is a snapshot, it just gives you a quick picture. I'm a picture person. I look at numbers and I'm like, ugh. So, I mean, I'll crunch numbers if I have to. You have to when you're doing money stuff, but I like pictures. Okay, so you want to look at the 1 year, and you want to look at the 5 year, and you want to see how this fund is doing. Does this look familiar? It looks really, really similar to the S&P 500 chart that we were just looking at. So that's the whole point. This is all about, you want to have and be in a fund that is just kind of matching up to an index. It makes it super easy for you. So you don't have to fret about like this one stock. I mean, if you guys get into stock trading, realize that you have to do this same thing for every single one of those stocks that you are going to buy or sell. You have to watch them all the time, because, and you have to know their charts, and you have to know their fundamentals, because if you get into stock trading, you want to know if that company is, you know, about to go bankrupt, or if they're making good financial decisions. Like, you have to get into all the fundamentals then, you know, if you're going to do that. So this makes it easy because you're just looking at one thing. Okay, you can buy many funds, which I'm going to give you different fund ticker symbols to be looking at. You can get into many funds, but realize in each of those funds, there's hundreds of companies. So if one of those companies goes bankrupt or tanks, it's not going to impact the fund as much. It's not like buying one stock and having, you know, a bankruptcy, and then all your money's gone. Okay, please don't put all your money in one stock. If you're working for a company right now and they are selling you shares, you know, or giving you shares, that's okay. Accept that as part of your retirement fund, but you need to be saving in other ways too, because if that company goes bad, all your money's gone. Okay, there's a lot of shady stuff going down with companies and what they're doing to people's pensions and all of that, and you don't want that. to happen to all of your money. So this is a safer way, okay, of doing things. So again, this is a ticker symbol. I'm going to bring it back up here to show you guys. VFIAX is the ticker symbol. And that is a Vanguard 500 index fund. If it says Admiral, that means generally that you have to have a greater sum of money in the Vanguard account. So I'm betting if you try to buy into this fund, it probably has a large minimum buy-in, like 10,000 or something like that. I'm going to give you ticker symbols for other funds, your Vanguard and Fidelity, that have lower minimums to them. Okay, but you can find that out by going to Vanguard and going to their fund list. Once you get to the fund list, then you click on the fund name, like Vanguard 500 Index, and it will bring up all the information on that fund, including how much it is to buy in, whether it's open or closed. Sometimes they close these funds to the public, and you're not allowed to buy in anymore. So I just want to show you guys a couple of these so you get an idea and you get a feel for how to use the charts. And remember, if it's on a dip, you need to be thinking, wow, that's actually a great time to buy. Okay, so while a ton of the public right now is freaking out and going, oh my God, my money, I want you to be excited because this is, if you're able to save your income, you are coming up on a great opportunity to buy in. Now, if you're watching this video and the chart you're looking at online with me is different, if it's now up, it's still a good time to buy in, okay? It's not like about good and bad here. It's just about like, I want you to be consistently doing it, automatically doing it, and just doing it, period. Because I know a ton of you out there maybe who are new to this, you're not even investing in a mutual fund or index fund. So I want you to just be consistent and be doing it. This is how I built my wealth. It was only, I'm going to tell you, my business was important. Having my business was important. The main reason behind that was because owning my own business meant I was making income, and it was for me. It was not for making someone else rich. The other reason having a business was good was because I was able to take tax deductions legally. Okay, it was not about me like, you know, taking illegal stuff. It was write-offs. You guys, when you own a business, when you buy a computer, it's a write-off. When you drive miles in your car, it's a write-off. When you need paper for, you know, printing out invoices, it's a write-off. Everything becomes a write-off, you know, when you own a business. So you make income, but then you get to offset, you know, your taxes with the deductions. So that was a huge, huge thing for me in terms of my wealth building, was owning a business. The reason I got into real estate was because I was making too much income. So, you know, at some point when you own a business and it's doing well, you're making tons of income, you're going to start paying tons of taxes. Okay, if you know, once you've purchased all these items you really need, like equipment and all of that, at some point down the road, you're not buying that stuff anymore to offset your taxes. So at some point down the road, I ended up with a ton of income, and I went, okay, how can I get write-offs again? And real estate was the way that I did that. So I started to educate myself. I started to go to seminars. I learned about how to invest in single-family homes, and again, buy and hold them long term. I am not about, I didn't want to flip. That's too much stress, okay? To have to go into a place and, you know, own it and be paying on it, and at the same time have to pay for, you know, flipping it and getting it ready, the stress of that, the money involved in that. I didn't want that. I just want to be able to buy something, own it as an asset, let it appreciate over time, and then rent it out and have somebody paying my mortgage, all the bills on the place. So these are things that I talk about in the blog, but it was those two things that started me off. But at the very beginning, I had to change my money mindset about my spending habits. I was in debt. I had credit card debt. I had school loan debt. I had card loan debt. I had all this debt. I needed to change my habits. And one of the pieces that helped me was in starting to save automatically, because that forced me to shift my habits. It forced me to no longer spend money that I didn't have. Okay, when you take money right off the top of your income and you set it aside, you no longer have that money to spend. It's out of your hands now. So it really does force you then to look at your money and say, okay, it's either I'm saving or I'm wasting, you know, on things that I don't need every month. So this technique that I'm showing you guys right now is the reason that I amassed enough money to be able to retire early in my 30s and then live off of the interest, the income that I make passively in the market. Okay, that's huge, you guys. So if you can do this, if you can change your habits, if you can, even if you're working for someone, you don't have to start a business. I want you to start a business, okay? But if you can't, for some reason, if you don't have the time, you know, to start something on the side, or if you just feel too stressed about that, I get it. It is stressful just as much as working is. But if you can't, if you have to work, then I want you to be maxing out your savings. You need to figure out a way to get to a point where you're saving a quarter, I'm like talking 25% of your pay, and build that up to 50% of your pay. That sounds like a lot, but it's totally possible. You can do this. You can figure out ways to cut your bills, to cut your spending, to not live in a wasteful way. It's good for the environment. It's good for you as a person to not be living in a wasteful way. And in that, you know, in that way, it just simplifies things for you, and it really teaches you about where true happiness comes from. True happiness is not going to come from these temporary spending habits, these temporary things. It just isn't. Okay, I've done that, and it doesn't. Those things don't make you happy. So do that for a while. If you have to learn your lesson, you know, do it. But then I'm telling you, change your habit somehow. I want to get into the other funds, and then I'm going to end the video for you guys. And if you have questions, then I want you to please post your question below the video, and I'd be happy to create a new video and link that to this one so that you guys can follow along and have your questions answered. But I'm hoping that I'm getting across this concept to you of how you can build up, you know, if you are able to save your money and build up it in an account and have it just sitting there, and you do that early in your lifetime, then you have a lot more time. If you see on this chart, you know, that we're looking at here, if you're able to put your money in 5 years ago, okay, at what is it, $170 somewhere in there a share in a fund like this. And you can save. Oops, there's a little dip, but didn't matter. Save. Oop, another little dip, but it didn't matter. Save. If you can keep doing that, then you are going to be able to get to a point where you're going to have a small fortune. All right. I clicked on the chart. I'm sorry. So I'm going back. So if you are able to do this over time, you're going to accrue over that 5 years a small fortune in your account. And I did this over 15 years. Okay. So imagine I just put my money in early, consistently put money in, and saved, and I increased the amount over time. So, I mean, if I could have saved, $1,000 a month to start, that would have been even better, but I couldn't afford that then, and I was too scared. I started at $100 a month, and then I slowly increased it. But if you can put in more, even earlier, that gives you more time. Okay, it's called compounding on your money. So it gives you more time for your money to increase, because every time it accrues interest and you have money in there, then it increases upon itself, upon its interest. Okay, so if you can give it more time and you can do it early, then you're going to amass a small fortune. And once you have that money in there, you could literally stop, okay, at 40 years old. I don't encourage that. I encourage still being frugal if you can, and still, saving your money. But you could literally stop, at some point, and just live off of the interest that you earn, from your account that is paying out to you. Okay, so I want to get that point across to you, that this is a tool. It's a way for you to retire early and have passive income. It's like building up a business and at some point handing over the business to managers and saying, you guys deal with it, and I'm going to go have, my life and have vacations and just live my life. And so it's like that, because it's considered passive income. So I just want to get that point across to you guys about how big this is. It can change your life, okay? And yes, it takes time and it takes years to do this, but if you can do it sooner, the better, okay? So I'm going to show you a couple of funds. So this is the Vanguard 500 index. I want to show you a couple more. So I'm going to go back to my portfolio, and I set up this fund list here. It's the index, I called it index fund watch list. If you want to jot down these fund ticker symbols, these are the ones that I suggest that you watch or you start watching. If you want to get into other mutual funds through Vanguard and Fidelity, that's totally fine. If you don't want to do index funds, but you want to just do a mutual fund, that's fine. When you go in and you look at the ticker symbols and you look at each fund, under all the fund lists in those company lists, just pay attention to the cost on each of them. You're going to see like 0.50, on some of them. You're going to see 0.10, usually on like the index funds, okay? And so the index funds tend to have a very low cost ratio. Other mutual funds may be around like 0.5% or something like that. That's still pretty good, okay? It's just, you can get further faster. You'll grow your money faster, of course, if it has a lower cost. Okay, so that's why I encourage you to look at those, and also because they're following an index. There's not a person managing it you know, that just gives it a whole other layer of trouble, you know, when you get a manager involved. Okay, the first two funds here have an F starting. That means they're with Fidelity. These that have the V, those are with Vanguard. Okay, so I'm going to show you guys. This is a fund here that is a growth fund with Fidelity. It's the Fidelity 500 Index Investor Fund. And here's the 5-year chart on that fund. It's a really good fund to be in, you guys. So this is one of my favorites that I suggest to people who are new to Fidelity. The letters are kind of easy to remember and a little bit funny. I'm not going to say them, but that's not a hard ticker symbol to remember. So if you want to try that one out to start, then definitely go for it. Again, I am not a financial advisor. I've just lived this life of, you know, owning a business and owning real estate and getting into investing and doing tons of training. So I'm just coming at this from my own experience, but I always give this disclaimer. If you're really scared about this and you want somebody to help you, then go get help. You can also talk to the people at Fidelity and Vanguard over the phone, and they will help you. They will be more than happy, you know, to help you, because like any advisor, they want you to invest, you know, your money with them. But just know that their fees are going to be much lower than if you go with some of these other companies that are out there. Okay, so you can take a look at some of these other funds in this little list that I've created. I would practice going in, making sure you're clicking on the 1 year, the 5 year, and the max charts, and really study them and see how they each do. Here's an example of another one. This is your Vanguard, the Vanguard Strategic Equity Fund. And if you look at this one was one that I was in, and I actually shifted my money out of because at the 5 year mark on this chart, it's actually down. And this fund has really only been going sideways, but it does pay great dividends. So it's not a bad fund to be in. It's a safe fund, but I look for uptrends and I look for performance when I look at charts. So the other tip to know about this, and I kind of going to wrap it up now, is when is a good time to shift out of a fund. And you don't want to be shifting out of the fund all the time because you incur taxes like capital gains and all of that. You want to be strategic about that, and you want to make sure that you're looking at how the fund performed over a couple of years. So if it's been down, you know, for like 2-3 years, then there's no reason to stay in that fund. You know, in my mind, that's like, okay, you know, at the 3 to 5 year mark, even like this, looking at this chart, if you're down, then I'm like, time to move on. Okay, so I want to give you guys an idea and I want you to make your own decision with these charts, with these funds. And I'm giving you examples so that you can go in and you can look at these and you can see the difference in the charts and make sure you're comparing with the same time frame, like 5 year, and keep going in and look at each of them and get an idea of what feels like a good chart to you. You know, what feels like a good fund to you. If you want to go even deeper, read the prospectus on the fund. The prospectus is available through the brokerage company like Vanguard or Fidelity. I think the prospectuses are available online now. They used to mail them to you. But you can read through and you can see what companies they invest in. I think they even list it. Yeah, over here on the Yahoo Finance page, over here down on the right, my picture is kind of in the way. These are the top holdings in this fund here. So it's actually showing you what companies are in this fund. You see they're all big companies, okay? And it's showing you the year-to-date return. That's what YTD means, year-to-date. The 5-year average return. So that's pretty good, you know, 11% for the 5-year return. So you want to be looking at, go even deeper into the fund. Once you are looking at it and you're saying, oh, this looks kind of good to me, I like this chart, go even deeper and see, you know, what they invest in. And then just make sure that you start off by having your automatic savings in place. So either start with your savings account or start with the brokerage account at Vanguard or Fidelity. And if you need help, you know, ask the people there how to set up a money market account, a money market fund. And a money market fund it's like a savings fund. It doesn't really invest in the stock market. So it's a very, very safe fund to have your money in. All right. So you just want to have your money automatically going into that fund. And then with that fund, you can buy and sell. So you can buy, you know, say once you have $2,000, you can buy into one of these index funds. So that's the next step to take. And once you've done it, then you can set up your money to be automatically buying in to that fund. So generally there's a minimum of like $2,000 or $2,500 to start to get into the fund itself, and then into like a particular index fund, and then you can have like $200 a month going into from your bank account into buying more shares of that fund. Okay, so that's totally doable. Just to have that set amount go over there. Don't touch it, right? Make sure you evaluate the chart, the fundamentals before you make a decision to switch it around. And then when you're ready, you can invest in like other funds. You can go even further with this. So you can have 2 or 3 funds going at a time, you know, to kind of even be more diversified. And of course, I only suggest this as one tool. There are many ways to be able to retire early, and this is just one of them. So if you guys have any questions, thank you so much for watching this entire video. If you have any questions, or if you're really needing more information on a particular, like a specific, then just ask your question below. Make sure to subscribe to this channel so that you can get more free information. I try to go really in depth with things, so I want you guys to get all the information that you can get, have it at your fingertips to be able to make good decisions, you know, with your finances. So thank you so much for watching, you guys, and definitely subscribe and let me know what else you need to know. Okay, thanks so much. Bye.